those of us in the industry dread this word, and I'm keen for you to explain what the process, because with Floorplan, we know that the financier owns the cars. It can be very attractive when someone pays out a nice 100 grand vehicle or pays you for a 100 grand vehicle, it drives away and you've now got 100 grand that you need to pay some of that back to the financier. What happens if a dealer doesn't pay it back quickly or doesn't pay it at all? And can you explain conversion to us?
So the dealer's agreement with the financier is in normal terms, there's usually a 24 or 48 hour time period that a dealer can, what we call, pay out that car. In other words, buy the car back from the financier and sell that car to the end owner of the vehicle. Where a dealer doesn't do that, the dealer is probably in breach of their financing agreement. And most of these financing agreements, the floor plan agreements, they have a thing called a GSA, or a general securities agreement, which basically says you have to give us the money every time you sell the car. And if you don't, we have the power to act against you. Conversion is where the dealer, for whatever reason, may or may not pay within that time period. Now, that can sometimes, it can be as simple as a systems outage, and that does happen these days. Used to be all done by check and go to the bank and all that kind of stuff. These days, if either the financier or the dealer or another form of digital communication breaks down, that can hold up a payment. But often, and 99% of the time, dealers pay out no problem. Every now and again, a dealer will forget, not whatever, pay out within that time period. That is known as conversion, and that's where the dealer is in default of the dealer's financing arrangement under the floor plan agreement. It's a fairly serious thing, and financiers do take that very, very seriously.
And what sort of actions would a financier take against a dealer in that situation?
One-off, usually a dealership would get a phone call saying, you owe us XYZ dollars on a car. And I might point out too that most floor plan agreements have an audit function that's written into the agreement. In other words, the financier can send one of his or one of the financier's people or a team of people to a dealership at any time under reasonable circumstances without notice, to make sure that all the cars that are being funded by the financier, and we talked about the fact the financier actually owns the cars under the bailment agreement, to make sure that they're still there. It can be an embarrassing situation. Cars get lost all the time, and cars are never always where they should be. A car could be offered a third-party supplier having a window tint done or alloy wheels fitted or mechanical or paint and panel done that the dealership doesn't actually do themselves, or for some reason they've sent it out. And that's usually just a phone call saying, look, the car is at XYZ, go and have a look. When a dealer gets a little bit habitual about being slow, that will set off an alarm bell with the financier, because when a dealer becomes habitual with not paying out timely bailments, that says there could be a systemic issue with the dealership. It could be a cash flow issue, could be a number of things, but usually when those things rear their ugly heads, they don't end well.
Alan, a question for me is, the financier owns the car. So can that car be registered before the financiers release that car?
Yes, all of that is done as part of the agreement. And again, that the conversion period or the payout period is already stipulated in that financing arrangement. Dealers have to have that done because to drive a car out of a dealership, of course, unless you're another licensed motor dealer with a trade plate, the car's got to be registered. So yes, that's allowable under the situation. And basically the 24 or 48 hours is usually based on customer delivery date and time. And that just allows business to happen well.